you can assume that this time next year, we're going to be in a better situation rate-wise, interest rate-wise, which makes good for certain stocks, right?
Right. Well, I think that you can get caught up in the moment and say, well, a quarter point, half point, quarter point, next meeting, this meeting.
Right.
What you have to recognize is the trajectory of rates, and the trajectory of rates is lower. And given that, and given what we know historically, despite what people say about pushing on a string, it doesn't matter. It's always mattered. And there are people who are professionally trotted out who say it doesn't matter. And they obviously are not running money. Because if they were running money, they know that what happens is that the comparisons get much easier because rates are lower. People refinance, so they have more money to spend. People feel better. Maybe people feel better at their houses. Maybe they flush money out of the sidelines and they put it in stocks and stocks go up. Whatever. There's lots of ways that things get better. You just have a better, more optimistic psychology. So when you can buy stocks of high-quality companies that sell at 10 times earnings, or that sell at they're growing or double-digit, and they sell at, say, 14 times earnings or 13 times earnings or 15 times earnings, it's a good dividend, 16 times earnings, if you have 11, 12% growth, you know, that's cheap. And, you know, for so many years we have heard that there's nothing cheap. And what I'm telling people is unless you have a full-blown recession, there's plenty of things that are cheap.
Okay, let's get to that working list. You mentioned Procter as one.
Well, Procter's historically had a really great dividend record. It's doing a lot. We know they're going to spin off Folgers. It's without a doubt one of the highest quality companies. It's double-digit grower, sells a very low multiple versus historical. And I think that a lot of that is because people just believe that people are going to cut back in Procter. And that's just not ever been historically the case. Obviously, the raw costs are a little bit higher because of the ingredients. But they're not so high as to make it so that that multiple should be as low as it is. I mean, I just was looking at Altria. I know that I didn't write about this yet, but I mean, Altria is a remarkable grower, particularly when you look at the overseas. And yet the multiple is ridiculously low despite the dividend. And I bring these out, Disney, and I'll talk about Disney more in a moment, but United Technologies, United Healthcare too, by the way. I bring this out because I always like to know the risk-reward before I buy anything. And these multiples do provide a floor. It's entirely possible, of course, that a company sells at 10 times earnings could sell at 8 times earnings. But at least you would have the certainty that you're not overpaying for once. And with the bull-bear ratio really, 40% bull, with the obvious decline in stocks, peak to trough, it makes sense to remember that things just aren't as bad as aren't as expensive, not bad, aren't as expensive as they were a year ago.
So the takeaway for investors when you're looking at stocks right now, look at the multiples
and
consider the rate environment.
Right.
In the year.
I mean, I'm always surprised when I talk with investors. They don't consider the multiple. They consider the stock, and they consider the stock cheap if the stock is down from its high, and expensive if it's above its historical levels. And I just urge people to realize that sometimes you get these stocks that have very low multiples, and that's when you look back and say, why didn't I pull the trigger on Disney at 28 when it was at 38? And the answer would be because you didn't recognize that it was inexpensive on future earnings.
All right, Jim, we're going to talk about Disney in another video. Thank you so much for Stocks on the Cheap in Wall Street Confidential. Stay tuned.
That's your action point. Take advantage of it.